Good morning and welcome to Market Monday for August 25th, 2025. Last week I dove into earnings, specifically the importance of earnings in the context of a fairly expensive stock market, by one metric at least. Well, here's another valuation metric showing a similar story. This orange diamond is where we currently are. My goodness, way up here for the US stock market. Here's the All-Country World Index, ACWI. And here's Europe, right here. Just about everywhere in the world, it appears stocks have a forward price to earnings ratio that is very high relative to the past 20 years. And when those earnings that I was talking about last week, when those earnings increase, it makes these orange dots come down or the stock market becoming cheaper. And not a minute too soon, we see continued earnings revisions at their highest since 2021. Here's the S&P 500 stock market here, of course, and you see the tariff tantrum earnings revisions, doom and gloom right here. Interestingly, almost coinciding with the market bottom. These are analysts' earnings revisions, and you know how we feel about analysts, so we have to take both downward and upward revisions with a grain of salt. Let's hope that they get this one right. Here's one last look at earnings. It's one of our favorite views of stock market returns. We talk about this from time to time, where the stock market returns are comprised of earnings, multiple, and dividends. We're only looking at a short time frame, the calendar year 2025. Here are earnings here, relatively consistent, stable, growing again recently, and here's the multiple. So we can see that despite decent earnings, it's the multiple or valuation that drove all the stock market volatility with tariff tantrum in April. So yes, we need earnings to support high stock market valuations, but even with decent earnings, we can still have a volatile stock market if investors get spooked and decide that they're not willing to pay as much for the earnings that we see here. This brings up an important point that we discuss here often on Market Monday, which is to be a critical thinker, especially in the age of intuition, where there's information overload, artificial intelligence, which sometimes does feel artificial. One example is not using the same old playbook from the past 40 years. Leading economic indicators, LEIs, as we well know, have been in negative territory just about longer than ever before, and certainly way longer without being in recession. So it hasn't had the same predictive recessionary effect as in decades past. Here, we're comparing it to coincident or current economic indicators. Again, where the relationship is now has marked the bottoms of recessions. Early 80s, global financial crisis here. There are clear reasons for this that are a bit beyond the scope of Market Monday, but point is, unless you're a critical thinker, this information could cause confusion. Another example where we need to be critical thinkers is stock market ownership. Going back to Black Monday, that day in 1987 when the stock market crashed 22% in one day, many pundits thought that sell-off could spill over into the economy, causing recession. But at that time, only 25% of households owned stocks in any form, stocks, mutual funds, etc. We see here, it wasn't until the 90s when the stock market ownership meaningfully increased, and today that number stands at 62%. We plan to dive into this topic in the weeks ahead, but for now, and since we haven't had an unemployment recession in over 15 years, perhaps next it won't be a slowing economy that causes the stock market to fall, but a falling stock market that might cause people to rein in their spending. Or maybe such widespread stock market ownership is supporting those high valuations that we mentioned earlier. Food for thought. Have a great week.